go ahead and try to record again, starting now, and see if we can pick it back up. All right, so let's go ahead and let's go ahead. It looks like it's going to let us pick up somewhere where we left off, which is right here. So that's pretty good. Bonus. All right, so if the stock price goes up, we lose money. Let's see where we can pick off, figure out the percentage return. If we end up with 1,600, we started with 2,400 relative to 2,400. I think we lost about 33%. All right. So we lost 33%. And what happens if the price goes down to 34? If it goes down to 34, that's hopefully where we make some money. All right. I hate to utilize this space, but let's see if I can. I get better at utilizing the space. See if I can erase that. All right. So if we started out with 2,400 as our investment, and 1 year later, the stock price goes down to 34. Remember we had, remember we had 6,400 total in assets. We owed 100 shares of stock. If it's now at $34, that means we owe 3,400. And we need to figure out what our equity position is. Okay, that's pretty easy. It's $3,000. So we started out with 2,400. The stock went down $6, so we should make about $6,000, which we can kind of see that we did. So 3,000 is our new equity position minus 2,400. That's the $600 profit relative to 2,400. It's 25%. Hold on a second. All right, so that's the $600. That was the Roomba that pulled the cord out. So maybe that was an earlier problem. So anyway, that's the $600 that we made, which gives us a 25% profit as a percentage return. Remember, the stock went down $6. So if you look at a $40 stock going down $6, that's a 15% decrease, yet we made a 25% return. Ending minus beginning over beginning. All right, let's stop the screen share and go back. All right, so not a perfect class, we had a few disruptions, but any questions so far? Well, let's go ahead and look at some of the book questions. And that should get us through chapter 2. Here I'm looking at the chapter 2 questions. And let's see if I can pull it up. And let me go ahead and screen share. And so it's going to look like these right here. Investments chapter 2 solution. And so it should see 1, 2, 3. I'll give you a minute to find your book. All right. So if we look at chapter 2, problem number 1. It's basically saying Carson Corporation sells stock for $17 a share. You decide to purchase as many shares as possible. You have 31,000. What's the maximum number of shares you can buy if the initial margin is 60%? All right, so this one's a little bit different, trying to figure out the maximum number of shares you can buy. Remember, what you can buy is the assets. You have 31,000 to invest, so that's your equity position. And now you want to buy it on a 60% margin. All right. Since your equity position is the 31,000, the market value of the transaction is the number of shares that you can buy if each share is trading for $17. All right, so now we've got to figure out, all you got to do is solve for the number of shares. Number of shares is 3,039. Okay. So the margin transaction percentage is exactly, the formula is exactly the same. Percent margin is equal to equity divided by market value of the transaction. In this case, we knew what the equity was, we just didn't know what the market value of the transaction was. All right, so number 2 was the next question. You will purchase 275 shares of Second Chance stock on margin at a price of $53. Hold on a second. The dog's barking. All right. So if you purchase 275 shares at a price of 53, that's $14,575. Your broker requires you to deposit $8,000. So $8,000 is now the equity that you put up. Therefore, your margin loan amount is just the difference between the two. Or $6,575. And if you want to figure out the percentage, so that's the dollar amount of the loan. If you want to figure out the percent margin, it's just the equity position divided by the market value of the transaction. We already knew the market value of the transaction at $14,575. So 8,000 divided by 14,575 is around 54.8%, 54.9%, which we just rounded up to 55. All right, any question on those two problems from the book? All right, so if we go back, I'll go back to the screen sharing, unless there's questions. I didn't see any. All right, so number 3 says, suppose the stock's at $62, what's your return? So it went from 53 to 62. So remember, we bought 275 shares. We had originally put up $8,000. And now we want to see what our ending equity is going to be now that the price has gone from 53 to 62. Okay. So remember, our equity changes when the price of the stock changes because that causes the assets to change. Since this is buying on margin, and they didn't tell us anything about a margin loan, so there isn't a, normally you'd include interest, but they're sort of ignoring that for now. What's going to happen to our new equity position? We've got 275 shares at $62. It's 17,050. Okay. Minus 6,575 gives us an ending equity at 10,475. If we want to calculate this as a percentage, ending minus beginning divided by beginning, around 31%. Okay. All right. And you can see we made a $2,475 profit. All right, without margin, what would the return have been if you purchased it without margin? Well, you can just kind of look at it. The stock went from what? 53. If you bought stock at 53 and it went to 62, it means you made $9. As a percentage, 62 minus 53 over 53. 16.98, or about 17%. So the stock went up 17, but you went up 31 because of the 55% margin that you started out with, or something close to it. All right. Finally, it says, what if the stock price is 46 when you sell? If it drops down to 46, what's going to happen? You've got 275 shares at $46. You still owe 6,575 in terms of a liability. So what's going to happen to your new equity position? Remember, the original equity position was 8,000. And now what is it at 46? Well, 275 times 46 is 12,650 minus 6,575 would leave you with an equity position of 6,075. So here was the equity when we started at 62. Here's the equity position if the stock drops to $46. Calculate that as a percentage. It's around 24.1% in terms of a loss. All right. Questions on any of those three? You can kind of see if you go back, there's other problems you can do, 6, 8, 9, 13, 15, 25. I was hoping to get through a few more than this today, but as always, there's some issues we have. You can hear my dog barking. The Roomba sucked up my cord. What else? That's about it. So, but overall, not too bad. We only got delayed about 5 or 10 minutes. If you kind of look at going forward, what's going to happen? Go ahead and look at the class schedule. I'll go ahead and send out probably an email through that Moodle attachment. At some point, we'll have a quiz over chapter 2. I might wait until Thursday to set that up and have you do it between Thursday and Tuesday of next week or something. I don't figure out what the best way is. It'll probably be in Dropbox, so you can download it. If you have problems printing or something, you can write it on a sheet of paper. And some people ask if they could email me. It's fine, but realistically, if you can email me, just take a picture and email the document to yourself, and then you can upload it back into Dropbox because it'll be on your computer if you email it to yourself. And you can put it in pictures. But if you need help or you have problems, just email me or call me, or you can just send it to me as an email if you want. I don't really care. One of those ways we'll get it all figured out. All right. Someone's got to have a question. Make sure you got to unmute and then make sure your thing's working. No questions at all? All right. Well, you want to do another problem, or you want to just end the class this time? No response. We might do another problem. All right. I guess we get to do another problem. All right. Let's look at number 6. I'm going to go ahead and screen share again. All right, so if you look at number 6, it basically says if you buy 500 shares of stock at a price of 38 and an initial margin of 60%, if the maintenance margin is 30, what price will you receive a margin call? All right. So now we've got to figure out what price will receive a margin call if we're buying 500 shares at 38. So our assets are 500 shares of stock. It's at $38. We've got an initial margin of 60%. So what that means is we've got to figure out the initial equity at $38. Now the market value of the transaction is known. It's 500 shares at $38. All right. So 500 times 38 is 19,000. Now we got to figure out what the initial equity position is. If you're putting up 60% of the value of the transaction, that means the equity position is 11,400. So the assets are worth 19,000. You put up 11,400. That means you borrowed, if you wanted to know, you borrowed $7,600. Okay. So we're going to have to know the amount that you borrow at some point in time, so you might as well do it now. All right. So now we've got the transaction set up, and now we're looking what price will trigger a margin call. So the margin call occurs at 30%. But in order to find, remember, the price is a variable. So we have over here, we have 500 shares, and we're trying to see, hey, when the price changes, what happens? Well, the liability stays at 7,600. The equity changes depending on this price. So we're going to put in equity as assets minus liabilities. We're going to write the assets as 500 P star. The liabilities is 7,600, and the market value of the transaction is 500 P star. Now we have one equation and one unknown. So remember, this equity is just assets minus liabilities. So we're substituting in for it. So now we rewrite this. That's 150 P star is equal to 500 P star minus 7,600. Move the 7,600 over here. Take the 150 over here. And 7,600 divided by 350. P star, now just solve for P star. P star is equal to 2171. So when the stock drops below 2171, that's when we'll have a margin call. Okay? Because that's the point at which the value of the assets are falling, our equity position is losing money, the liability stays the same. I'm starting to lag just a little bit, but it didn't kick out on me, so that's good. All right, let's see if we can do number 8, and that'll probably be the last one we get to. But 8 looks like it's a short sale, so that's good. All right, the stock of Flop Industries is trading at $48. You feel the stock price will decline, so you want to short 1,000 shares. And the current price right now is 48. So what you're actually going to do is borrow 1,000 shares from someone and sell them today for cash. So what's going to happen is you're going to have $48,000 in an account because you borrowed the shares and sold them today for cash. But you're also going to have to put up a deposit, a margin deposit. Okay? And that margin deposit is the equity amount. In this case, since there's 1,000 shares, the market value of the transaction is $48,000. Then the equity position is going to be 60% of that. Or the equity position is going to be 28,800. So actually what you're going to have to put up is 28,800 of your money. In fact, that's the equity position. What you owe is 1,000 shares of stock, which right now is priced at $48 and is worth $48,000. Okay? But of course, when the price changes, so will this liability. So the question is, if the maintenance margin is 30%, at what price will you receive a margin call? So now we've got to go and figure out if we have a 30% maintenance margin, what's the equity need to be in order for that to be 30%? Well, in this case, we're going to take the assets minus the liabilities. Now remember, the assets are worth $76,000 total. And the liability is the 1,000 shares of stock. That's what's influencing our final equity. This was the initial equity. Okay? That 2,800 was the initial equity when the shares were trading at 48. Now we're going to see what happens when the price changes. When the price changes, your liability is going to change. And since there's 76,000 in cash, part of that was from the initial short sale. Part of that was your investment in the short sale or your initial margin deposit. That's what makes it kind of awkward. Okay? Is that you got to figure out that this 4,800 resulted from borrowing 1,000 shares and selling them for cash at $48. Now you got to buy them back. And with the price you buy it back at is this price here. Okay? But they want to make sure that if that price goes up, it doesn't go above $76. Okay? In fact, they want to create a buffer because if it goes above $76, you don't have enough money to replace the shares. So they want to create a buffer. Right now it's trading at 48. If it were to climb higher, okay, then there'll be a margin call to make sure that there's plenty of money available to repurchase the shares. We're just going to try to figure out what that price is. So here's the 7,600 that we have. Here's what we owe, and this is the market value of the transaction. So now if we solve this equation, $76,000 divided by 1,300 is 5846. Uh-oh. What happened? Oh, sorry. This is 76,800. I'm sorry. All right. 76,800 divided by 1,300. 5908. Okay. So remember, this is 48,000 plus 28,800. I forgot about the 800. So my assets are 76,800. And that's the liability. All right. All right.